The following is a guide to a day trading principle for small cap stocks. It should be noted that day trading is risky, and most likely when people day trade, they lose all their money. A 3x3 grid can generally be used to predict the response of a stock to news events based on its expected value from investor actions. On the vertical side, we graph the expectation, which is the popular expectation based on whether investors are short or long, just in general. So if there's a high percentage of short shares, then that means the expectation is negative. If most investors are long, then that shows that the expectation is positive. And if there's kind of a neutral hype with this stock, like investors are just waiting for something to happen, then we'll just consider that to be zero. And so on the horizontal side, we plot the news, and it can be positive or negative. The news for stocks is generally positive or negative, or they wouldn't actually be putting out something with regard to that stock. And then you have the situation where there is simply no news, and that can affect a stock, because if a large part of its value is driven by speculation, then when the news suddenly just goes out about that stock, then people stop wanting to buy it because it's not really in speculative fashion anymore. And so the use of this grid is as follows. If the stock has a positive news event and it's expected to go up, then it'll probably continue to go up because the hype has been satisfied, and investors who followed the hype will feel a sense of justification and they'll continue to buy. Then if the stock was expected to go down and now it's going up, then you'll get something called a short squeeze, where like most of the investors, sometimes most of the investors or a portion of the investors were short on that stock, and now they all race to cover their short, and so everyone's buying, and it goes way artificially up. And now finally you have the situation where there wasn't really that much of an expectation to begin with, and so you'll just get a normal sort of jump, like that kind of thing, where it's just kind of low, and then the next day it's kind of trading higher. And so on the negative side, what if the news is negative? So if everyone was buying it and now they suddenly find out a bad thing about it, it'll probably go down substantially, because people's stop losses may kick in on the long side of things, and there will be a lot of panic selling, even though what they should be doing is holding on to it and maybe even buying more because now it's undervalued. So on the negative, so double negative, that means like suspicion confirmed, it's going down, and they'll just sort of continue to go down, and like investors will sort of feel right, like the stock is going down, so people will keep selling, and sort of like the positive side. And then if it's a negative news story and there's no expectation, you'll just get the normal sell-off. Now, the interesting part is when there's a lack of news. So if investors are sort of left hanging expecting it to go up, and then it sort of goes out of speculative favor, then a lot of times you'll get a sort of a gradual decay, kind of like this. And then that kind of leaves investors hanging, and eventually they just sell off, contributing to the decay. And so that's not something you want to get stuck in. And then at the same time, if people are expecting it to go down, there's short volume. I mean, it rarely happens that there's no news when there's short volume, but sometimes this will happen. And then you could get a slight positive effect from the covering as people realize that they're just sort of wasting their time paying interest on the short. And so they'll kind of prop it up for a while just by covering, but then eventually it'll just decay if there's really no news on it. And then finally, you just have the neutral situation where investors are kind of waiting for something to happen, but then it never happens. And so in that case, you just kind of get this sort of same decay over time. So the real action is happening in these first two columns, where sort of overshoot in the stock response to a news article can result in like a buying opportunity or a short selling opportunity. But just watch out not to be caught in a short squeeze, because that can also result. So this 3x3 grid can be used to easily determine just the generally what you should expect when a stock reacts to a news event. With these two, there can be an extreme reaction that it sort of overshoots and then results in a profit opportunity sort of afterwards that. And then in addition, these two just sort of keep the trend alive, but it's kind of dangerous because the trend might then be pulled down by a negative news story. And then at the same time, you have the situation where you just have a sort of a normal response to the news story. And so I believe that this grid fairly accurately summarizes the general principles of news-driven investing.